Thanks for tuning in to Bloomberg Quint. 2018 was a tough year for investors and fund managers all around, be it equities, commodities, or other asset classes. No surprise then that portfolio managers also had to settle for less. But like always, there are some who managed to take the knock on the chin and stand ground when compared to certain others and compared to benchmarks. And today, we have three money managers whose teams and whose portfolios stand testament to their performance in calendar year 18. Joining us here in our studios is Gaurav Avasthi, Senior Partner at IIFL Investment Managers, Jinal Sheth of Multi-Act Equity Consultancy, and Somil Zaveri of Portfolio Manager at DMZ Partners. Gentlemen, all of you, thank you so much for joining in. And at the outset, congratulations to you and your teams for doing really well in calendar year 18. Somil, let me start off with you.
Sure.
What stood you in good stead in 2018? Because it was a difficult year.
Yeah, absolutely. At the risk of, saying something relatively generic, we put it into three pieces. The first is basically a bottoms-up approach to, picking our spots carefully and high conviction ideas which allow us to really build on that concentration on these businesses. The second is size, right? If we were managing several thousand crores as opposed to a couple hundred or a couple thousand crores, we're at a very distinct advantage because you can go in niches and pockets that you otherwise can't explore. So these are two structural advantages we think which hold anyone managing less than $1 billion in really good stead at times like these, because you can really take position-specific ideas, scale them up, and be agile, which you just can't do with larger pools of capital.
Yeah.
And the final thing, which I think is relatively undervalued in our community, is the quality of the investor base. Having a small set of investor base that truly understands the investment approach gives you the leeway to diverge from what broader markets are doing over shorter periods of time. And that's very critical, because if you have an investor base that's going to call you every quarter or two and ask you why you're a couple bips here or there, you lose a very important structural advantage. So those are three things which are very fundamental to our approach, which held us in good stead in what was otherwise a turbulent year.
It was. And Jinal, your performance shows that you managed to beat the benchmark and some of your peers quite handsomely as well. What worked for you, what didn't, and did you do something which was renewed in 2018, or was it something, were there some bets that you had taken earlier which kind of started paying dividends in calendar year 18?
So as you clearly mentioned, it was not the effort in 18, but more so before. So the seeds were sown in 16, 17. So we were telling our clients that the small and mid-cap space was, the valuations out there were getting out of comfort, and it got worse in 17, where obviously the markets did pretty well. And on an absolute basis, we were fine, but usually multi-act tends to underperform in a phase of the bare end of a bull market. So at that point of time, in 16, 17, we started identifying businesses, the high-quality businesses which weren't doing well. That's where you were getting value and comfort. So we kind of build up out there, and we were okay kind of underperforming in that bull market. And as Somil mentioned, the client base is so important in this business. If they believe in you, they stick by you, and then it becomes easier for a fund manager to do their job. And that kind of really helped us in 18, and we stood ground because of the kind of bets we took in 17 and 18, and 16 and 17. That helped us kind of outperform in 18.
Okay, I'm going to come back to that as well. But, the key point out here in all of these conversations is really, one, yes, the kind of clients that you have, and two, the strategies that you take. But Gaurav, a larger size, relatively larger size portfolio that you guys run as well, and still managing to do so well. Was there, again, a similar question, something renewed that happened in 2018? Or was it that your bets taken earlier in 2017 or 2016 continued doing well, and maybe you were not present in certain pockets which, for lack of a better word, really sank because of multiple issues that happened in 2018?
So I think from our perspective, the focus on risk is very, very high. And from a valuation perspective, clearly, as mentioned earlier, the valuations for small and mid cap were going through the roof. And I think late last year, early this year, we were completely out of mid and small caps. And even in the large cap space, we had become far more quality conscious, more quality focused. And I think that really helped us get out of this volatility in good shape.
Well, the ones who have underperformed as well, there are a bunch of guys whose portfolios, and I know them very well, their portfolios are strictly quality. Somehow it didn't do well. So my question then therefore to each of you is, and I'm sure all those guys also, large, mid, small, have client bases who are fairly loyal to them because it's been years of performance that has happened. But something did click for them in 2018 and something clicked for you guys in 2018. So I'm trying to get a sense of as to what made you take the decisions that you guys took on those specific sectors, on those specific stocks that worked. And that's what I want to start with you. I mean, what spaces or what themes that you had invested in or stayed invested in 2018 really worked, and why did you take those bets?
So, while as you said, a lot of the quality pack also, did not do that well. But again, even in the quality pack, valuations at the end of the day matter. And a lot of stuff, a lot of stories were being thought of in terms of that these growth rates were eternal. So, the NBFC crisis that happened recently, I think everybody in the world knew that there was a ALM mismatch that was happening. It was just that the risk was not out in the market.
Yeah.
And until one day it came out and suddenly everything collapsed. So, for a lot of these high PE companies, I think the other question was that till the growth is there, valuations will sustain. And as soon as, growth started dipping off, for a lot of these names, you suddenly found valuations becoming far, far more cheaper.
Sure.
So while we said quality, I think the quality for us was not in terms of really necessarily high PE. Quality for us was low debt. Quality for us was where in an expensive market do you think you will not lose money?
Okay, so did you guys kind of move out of select NBFCs before the IL&FS storm hit the market?
Correct. So, you
took that call.
So I'll also switch slightly to the debt view. So even on the debt view, if you look at the pricing that was happening in the debt market in terms of how credit was being priced, debt pricing and credit pricing was extremely mispriced in India. The kind of yields that you were getting for a lot of players, the spread between AAA and let's say a AA was hardly there. So even today, if you look at, while the entire world, the single A spread has actually shot through the roof. In India, it's actually reversed. For the last 3 months, if you look at valuation tables, the spread in India has actually decreased, which maybe begs a question that, there is more damage to come, maybe in that part of the credit market.
Interesting. And the jury's, down the middle out there. Almost everybody has a counter opinion to every single point being made in that pocket. But it's a very interesting point, and I'll come to outlook for 2019 as well. But Jinal, the same question to you. So one is the philosophy that you guys had, and maybe the client base also helps, etc. Two is the kind of bets that you take. Now, you alluded to your bets taken earlier and not necessarily in 2018, which helped you. What was it that you had taken earlier, which you stood by, and were you out of the minefields before they exploded?
Yeah, so this, coming back to the small and mid-cap space, I mean, according to us in 16-17, they had actually surpassed +2 standard deviations in terms of the PE bands historically. And we saw that, look, the major re-rating in the market, it's actually there was a re-rating rather than earnings growth coming through, and obviously that's been liquidity driven, right? So in our sense, the small mid-cap mix by 17 had actually come down to sub 30-40, and whatever positions we had in those hadn't really done well, and there was some valuation comfort, and we believe that, look, over the next 3 to 4 years, earnings growth would come through there, and hence you could have that expectation of a return. But some of the bets, for example, in 16-17, like if you take the IT sector, there was a complete dud where people had given up on the sector. So obviously there were certain cyclical issues and there were structural issues. We believe that, look, even if you factored in the structural issues, the kind of valuations that were kind of pricing these large companies that, today are dealing with the Fortune 500 companies, they were literally priced for no growth. So we believe that, look, and it was highly under-owned as well. So we didn't mind taking that contra bet. And then you had certain domestic pharma names that we were okay to go with. But some of that, we are actually seeing some valuation comfort coming through in the generic space today, unlike, a few years back, where pricing is kind of stabilizing, especially, in the US and all of that. And then there were certain other contrarian bets, niche, I would say more like niche bets that we had taken. And we believe that, look, the downside was really, really limited. Balance sheets were quite clean. And so majority of our positions, if you look at the balance sheets, either they're net cash or then, you have some of them minimal debt to that extent. So that's how we were placing ourselves and our portfolios, knowing that, look, we were not comfortable what's brewing in 17. And as we all know, that it's always, you will be caught by surprise.
Yeah,
so,
sure.
And lastly, the when we were getting portfolios in 17, I mean, by November, December, we were deploying only around 20 to 30% in equity, remaining was in cash. So we do take that asset allocation call as well. So that obviously the equity plus that, the equity positions plus the cash kind of helped us to that extent.
Okay, interesting. Well, very few people, I believe a fraction would have taken that call at that point of time, even though the risks, on hindsight, the risks looked imminent. It's only where in the moment that the risks don't look quite that imminent. Now, Saumil, I presume you guys are 100% equities and normally 100% invested. What worked for you in 2018? Simply because I also know, and we'll come to the outlook for 2019 or the current year as well, that you are still bullish on the pockets that led the rally in a better part of 2017 and 2018 as well, which is consumers, consumer financing. And those were the pockets that actually dissed out a lot of portfolios in the second half of 2018. So what stood you in good stead? What bets had you taken which worked for you?
Yeah, absolutely. I mean, I was about to speak to your point in that we have 50% financials, 25% platform businesses or marketplaces, and the other 1/4 is roughly consumer businesses.
Now. Was that
And
the case in 2018
that
as
was
well?
more or less the case in 2018 as well. So to speak to one of your earlier points is that returns are exceptionally lumpy. Right? When you own 10 businesses, 5 of which or 6 of which maybe 80 or 90% of the portfolio, I hope my words don't turn out to be prophetic for any one of us, but someone in the top 10 can well find themselves in the bottom 10 the next year. And that's not a function of necessarily something they did wrong if they have a multi-year type horizon. So as you said, a lot of quality investors, great allocators find themselves having a tough time in the past year, and that's natural. That comes with the turf. That said, one of the things which we take great pride in is this approach towards qualitative arbitrage, and I think everyone kind of spoke to that at some length, which is essentially basically appreciating certain aspects of businesses which don't translate well on a spreadsheet. Sounds a little romantic, but the essence is very simple. Basically, there are aspects associated with great owner-operators, aspects associated with purpose-driven organizations which have very low market shares or adoption rates, which buffers them from what broadly happens in that sector, in that industry, or in political scenarios or macroeconomic scenarios. And basically, we try to go to these insulated zones, what we call them as. And we stay clear of blind spots. Look, we don't understand IT, we don't understand pharma, and we stay clear. So, this combination of, having a deep qualitative focus in underwriting great businesses combined with staying clear of stuff we just don't get.
Okay, give me an example. I don't want to get into something that you are buying or want to buy, etc. and stuff like that, but something that you've placed a bet on and fits in within these criteria. What worked for you in 2018?
Absolutely. So for everyone that speaks about quality, one of the things which we think is a real steward of what quality investing, case study stands for is Bajaj Finance, right? And we still own Bajaj Finance, and it's a poster boy. And look, for us, a lot of the growth, a lot of the opportunity set is in the windshield as opposed to the rearview mirror. If we look at the size of the industry, if you look at more than 100 lakh crore, 1 trillion rupees of potential banking sector credit, the 1 lakh crore is a very large market opportunity for someone that maybe is at 85,000 crores of AUM today. So when you have these really long runways, you can't just say, okay, the opportunity set is great. You have to be case specific. You have to choose that owner operator. You have to choose that duo of Sanjeev Bajaj and a Rajiv Jain. And these are very, very exceptional entities they've built in terms of, underwriting credit in very short periods of time at retail outlets, underwriting cautiously while doing that. You're straddling these things which are opposing forces. Grow at scale, but maintain underwriting discipline. Right, underwrite quickly but maintain underwriting. These are very tough things for others to replicate. True. And so people that have these edges, or what we call these moats, are likely to enjoy them for long periods of time if they continue to invest in them. And we see Bajaj Finance as a, as you said, poster boy for all that they do right in terms of, planning 3 years early, 4 years early, where they want to be. So that's an example at pick.
Interesting. By the way, viewers, please remember, none of the things that we discuss are recommendatory in nature. This is just to get a sense from these gentlemen about how they think about their investments in order to probably help you and me dissect what the best investors in 2018 have done. Now, Jinal, you spoke about pharma, and that was a pocket that you probably foresaw a bit earlier. You saw some problems there, and now you see the problems dissipating. I'm kind of extending the discussion to what you saw in 2018 versus what you might see in 2019 as well. A lot of people that I speak to and eminent pharma experts now keep on telling me that the next leg of growth could come into the API businesses, because China is opening up as a big market as well, and Indian companies are getting permissions, etc. How do you see the landscape for 2019 for your portfolios and for pharma in particular?
So, most importantly in pharma, what we do notice is that the competition in pricing is kind of just stabilizing, unlike what we saw in the last couple of years, like last 2-3 years. So what's happened in the US is that basically you've seen a consolidation on the purchasers out there. So there were earlier 7 players, which has kind of shrunk. And what we've actually seen is that, so some of the guys, the domestic, unlike when we look at the export plays, what we are trying to, we are trying to play with is basically they're taking a longer term, when we look at capital allocation, they're saying that they're taking a longer term call, that over a 3-4 year call, that how they are placing their bets, where are they placing their bets. So in that sense, when you look at the entire cycle in the past, these companies have played, when you look at the return on capital employed, their balance sheet, we're okay at this point of time, considering where the valuations are, taking those bets. And but along with that, some of the bets that we're taking were more domestic pharma plays, the multinational companies, where there were a lot of negatives in the last few years with the pharma policy in play. You had regulatory concerns. So that's where we kind of really found some ideas. And we believe that, look, these are more like FMCG plays. They don't really require capital. Growth isn't very, very high, but if you're able to grow 12 to 15%, and we know that that's possible over the next decade, we're kind of okay taking those plays, and for the valuation that you were getting them. So they've kind of stood ground in this particular year. So that's something more on the pharma side.
Okay, that's what stood you well in 2018, you were saying.
I would say that, in fact, the kind of bet also we took last year was that there is an API and a custom synthesis player, DV's Lab, right? We always liked that business, but we never entered it from a valuation point of view. Only when they were hit by the import alert is when we actually came in. At that point of time, we just asked ourselves a few simple questions, like, look, these guys are very, the kind of relations they have with the global innovators, they're very exclusive. They've been with them for the last 25, 30 years. And, you've really seen consistency out there. So we believe that, look, it's a matter of time, maybe 2 years, 3 years, that things will be out of the way. We got lucky that the import alert resolution got done in less than a year. No pharma company has ever seen that, because they're not really competing with an innovator out there.
Sure.
So that's obviously, that also kind of helped us. And another play that helped us was, other than the pharma space, was on the consumer space, was the company called Jubilant FoodWorks.
Sure.
Right. So that, again, a year, 2 years back, industry was going through a real slowdown. There was competition from, so basically the wallet share had expanded for a consumer where he had more choices. You had the Zomato, Swiggy, available at your doorstep. So from that angle, we had studied this business at a global level. Today, if you look at Domino's globally, it's one of the most profitable restaurant businesses in the world. And it was a matter of time. We believe that, look, the same-store sales growth would come back, to normalcy. Even if you take developed markets today, if you take UK, or the same-store sales growth out there are in the higher single digits or so. So with India, we believe that, look, there is growth, and there's a growth opportunity, there's profitability. So we were just kind of, again, playing a contra bet that, look, at this point of time, people are kind of really negative on these names. But then again, we decided to... You're
going out looking for areas where people might be negative and valuations might be in your favor.
Right.
And that stood you well in 2018.
Yes.
Okay, we'll come back to where are those pockets in 2019 and where your portfolio is adjusted towards to make maximum benefit in the year. But to you, Gaurav, and what's been that standout set of bets that you guys took in allocation or being contrarian or otherwise, which stood you really well in 2018?
So let me go back to the view that we had in the beginning of 2018. So the view that was emerging was that the world is growing. So if you look at ex-US, the rest of the world was gradually slowing down. I think US was the only outlier which continued to grow because of the policies of Mr. Trump.
Sure.
You look, the other view that was clearly there was that interest rates are on the way up. Because of whatever is happening around the globe, from tightening to the fact that, you didn't know when this cycle will end. Crude was obviously, was not there as the part of the base case at that point of time. And the fact that you expected interest rates to go up, the fact that you expected global growth to slow down, then actually went out in the allocation. That means clearly that anything which is very linked to the global economy, for example, commodities, is something that you will want to start avoiding. What is very linked to interest rates, so clearly NBFCs, for example. So while we can't claim that we saw the NBFC crisis in any way.
Most people can't, but that's okay.
The point is that you could see that if interest rates are rising, then the kind of competition that NBFCs were giving to banks, that will start subsiding. Banks will start getting far more competitive going ahead. And especially if you look at HFCs, the underlying real estate market is not doing well. So at some point of time, that growth has to slow down. Till your base market starts creaking, and we all know where the real estate market is right now from a sales velocity perspective. So unless that picks up, the growth which is riding on top also has to slow down.
So you took the bet before LNFS hit.
So this, because of the fact that the front view was that we think interest rates are going up in the economy.
Sure.
So if my two broad views are that world is slowing down and at the same time interest rates are going up, then the first allocation bet is anything that has to do to the global economy, you want to slowly start getting out. The second view is that anybody who's really taken advantage of this entire swing of the interest rates on the upswing is going to get hurt. And I think that for us played out.
Interesting. Saumil, since you're overly positioned on financials, and I don't know if NBFCs form a part, is that a view for 2019? I'll come back to you, Gaurav, as well on your view for this, but what's the thought for 2019 for the financials?
Yeah, Neeraj, you'll be surprised. Very audacious or outlandish approach we follow, rather unconventional in the sense that, we tend not to be very minutely focused on what interest rates will do over a year. Right?
It's a style, that's okay.
And that's very fundamental to our approach because, what we are in it for is this element of time arbitrage when others are focusing on, things which are 3 months, 6 months, 9 months out, which will have meaningful impacts on some of these businesses. It's not to deny that or not to be dismissive of that. But having said that, some of these businesses have scalability prospects that cannot be measured in those time frames. I mean, you take, if I can throw out another example, again, not stock recommendation or anything of that sort, but you take a business like Eicher Motors. You take the stewardship of that brand and business. And when they report weak monthly sales numbers, right, it's almost comical to me. Like you think of Sherwin-Williams, the paint business in the US over the last decade. If they were to publish liters of paint sold every month, I mean, and if anyone were to pass actionable judgments on that, it would be a real folly because the story played out over a multi-decade horizon. So in our approach, because we have a very clear mandate, we view ourselves as a family investment office for a very limited number of families. And the approach and the mandate is very simple. Buy irreplicable assets with irreplaceable capital. And so we need to mute out some of these things which we just aren't qualified enough to comment on.
Okay.
Whether it's where interest rates will be, whether it's where we view the interest rate cycle, those are just things we kind of zone out of because we say, look, hey, this is a zone of expertise that we just can't curate. It's not a zone of expertise we can cultivate. So, let's operate in zones where those competencies aren't critical.
Fair point. What's your view, though, Gaurav, for 2019, 2018? That holding that view held you in good stead.
Correct.
What happens in this year?
So I think the view as of now sustains that global growth continues to slow down, and now the US has also, I think, joined the pack. So anything which is very outwardly looking may not still be a great idea. I think even from a market capitalization point of view, while mid caps, small caps have corrected substantially, but if you look at valuations around the mean, they are still higher. So, and that is actually true. So We remain cautious in our stance of equity. We are not really over bullish right now. We don't think that you are going to get substantial returns. You may, best case, get low double-digit returns, is the sense that we have. And especially with a lot of volatility in the first half. I think the key in the markets is that earnings someday has to revive. So it's been 4 years now. Every year, people hope, and the first quarter will come in. Then we move to H2. So let's hope, and this is another. If earnings actually come up as people are expecting, that the capex cycle is reviving, capacity utilization is going up. So if those things play to plan, then obviously you will probably have a huge swing where capex and related sectors may start doing well. But rather than jumping into it, I think it's best to wait for evidence.
Okay, wait for the print. That's the call that I think they're taking. Jinal, it's not a misnomer that the global economy is slowing. You seem to like pharma. You seem to understand information technology very well, which means that you have a good handle on the export-oriented themes within India. What's your outlook there? Is your portfolio positioned in large buckets towards those bets? And if so, why is it in the event of the global economy not looking as good as it was in 2018?
So just to start off with, I'm in sync with what Gaurav is saying, that we are kind of cautiously optimistic, and especially when you look at although we've had the correction in the small and mid cap space, we're not comfortable as yet. So to come back to your question, I wouldn't say we are experts on IT to that extent, but what we do...
Done well, let's put it that way.
So the way I would understand is that we focus a lot on valuation. So we do consider that what's being priced in. And to that extent, we do believe that there is some valuation comfort if you look at it in IT, pharma. In fact, some of that is emerging in the two-wheeler space, as he mentioned, to that extent. So we believe that most of these stocks are really not being priced for growth, and we're talking about trend growth. We're not really talking about the high double-digit growth to that extent. So that's one avenue where we are finding value. There's another trend that we're seeing is that we're kind of micro trends over the next 3 to 4 years. What we are identifying is that there are certain pocket of opportunities. If we were to put it in terms of, let's talk about air pollution, or even wastewater treatment, and in fact, what we are seeing is there's a certain shrinkage of foundry capacity globally. So that has an impact on India to an extent, and the foundry makers and niche players supplying to that. So that's one way of a micro view that we're taking, and we're finding value there to that extent. So it's going to be hard work, as Gaurav mentioned, but that's where expertise will come in to try and kind of survive there.
Yeah, well, well, it should be hard work. It shouldn't be easy, and frankly, equities isn't easy for anybody who thought that. I think 2018 was a rude jolt, and which is great. As somebody told us that even for money managers, right? Somebody who had come on our show, Alpha Mughals, had said that as money managers, we are so focused on picking businesses that we ignore the macro until it comes and hits us hard, and then we take cognizance of that. Hey, we do need to look at it sometimes. Okay, final thoughts really, and Somil, just wondering. Actually, I've asked both of them about their portfolio stance. You've kind of mentioned the interesting part in your portfolio stance was, I believe, what you mentioned, 25% allocation to marketplaces?
Yeah.
What's the rationale here?
Yeah, so basically we think there's a bunch of businesses which are emerging, which are no longer in their core sector as much as they are technology companies which happen to be in the business of lending, or technology companies which happen to be in the business of staffing, or technology companies which happen to be in the business of how power is traded in our country, or and there's exceptionally long runways that are present here, and these are very nascent businesses, very nascent opportunities. I mean, you look at the short-term power market in this country, something like the power traded on exchanges is 3% of the total power or total electricity traded in the country. I mean, and when you think of the kind of runways possible here for marketplaces that can emerge and are emerging, that's a space we are very optimistic on. And we have this bucket in our portfolio we call the tail, right? Because it's really, seeds that we've sown or businesses that we think can be substantially larger contributors to the portfolio over time. And that's where we are seeing them, these platform style businesses or tech enabled businesses.
Okay, interesting. Final comment, 30 seconds each, gentlemen. Can't not have a conversation with money managers without talking about the one favorite book that they've read in 2018 or they're reading right now. The best recommendations, 30 seconds because we're out of time on the show. Samuel, I'll start off with you first.
Yeah.
The one book that you would recommend.
Bad Blood by John Carreyrou.
Reason being?
Just a great insight on how much you have to think about corporate governance irrespective of who your other shareholders are.
Okay, it's actually emerged as a recommendation by a lot of people, but Bad Blood is the one that you recommend.
Absolutely.
Okay, what about you, Jinal?
I'm bad with names, but the recent market moguls of the Indian investors that I've just been reading that.
Oh, yes, of
and
course.
that's pretty useful. You're trying to get an understanding of all the different great investors that we've seen in India. So that's been very useful.
Well, that's the attempt of the show as well. Your final.
So I think you should read Thinking Fast and Thinking Slow by Daniel Kahneman, because I think if you are able to control your emotions, you will make far more money in the markets.
Okay, Jamin, on that note, thank you so much for joining in today. Congratulations on a very good 2018 and hope you keep up the good work in 2019 as well. All of you, thank you so much for joining in.
Thanks for having us.
And viewers, thanks for tuning in to this broadcast from Bloomberg Quint.